First thing we're going to talk about is what? What is a PE ratio and what does it represent? Second of all, we're going to talk about how. How do we calculate a PE ratio? How do we get to it? And how do we visualize it using graphs? Second of all, we're going to talk about why. Why we have this ratio, this number, and how we use it in valuing a company or deciding whether to invest or trade in it. So let's get started. First of all, what is a PE ratio? And a PE ratio is divided into PE and ratio, of course. And a ratio means something divided by something else. And PE is price and earnings. So, using ratio, we know that we're getting to a number that is a division, and P and E is price and earnings. So we have price divided by earnings. So that leads us to what it is. It is a ratio of the price of a company to its earnings. Now, when we talk about companies in general, and we talk about their numbers, we generally talk about 1 year of the company's achievements. For example, a dividend is calculated by how much money a company has paid in the last 12 months. And when we are talking about earnings, we're talking about how much has the company earned in the last 12 months. But the price is, of course, the price of the company, not change or anything like that. So that's it for what a PE ratio is. We can mark that down. Now, how? How do we get to a PE ratio? Well, a PE ratio can be calculated in 2 ways, basically. First of all, we can calculate it by the entire price, or otherwise known as market cap of a company, divided by the entire company's GAAP profits. And GAAP stands for Generally Accepted Accounting Practices, which just takes down different types of transactions from the company to make sure that the earnings are being represented by money that the company is making, no matter what it did. So not necessarily the bottom line, but we're not going to get into that. And another way is to divide the price of the stock or of one share of the company by EPS. And EPS stands for earnings. I think you can guess what PS is for, as we're taking the price of one share, earnings per share. So if we have a company that has an EPS for the last 12 months of $1, and the company's share is $100, then we have a PE ratio of 100. And it would be the same if, for example, we found out that what it is worth, for example, is $200 billion, and the amount of money that it made in the last year was $2 billion. And this is, of course, in GAAP profits, not necessarily revenue. That is a whole other number. So that is how we get to the number. How do we visualize it? Well, this number is a ratio of 2 other numbers that are constantly changing. For example, a company can drop out its new quarterly statements and financial statements, and that will change the earnings, because now we're looking at the 4 other quarters being added up to 12 months, and more importantly, the price of the company can change. So in the stock market, the price can one day be $100 per share, $200 billion for the entire company, and the next day 3 times that, or a third of that, or anything like that. So if we have a graph of PE ratio. So this is PE as of time. It isn't exactly easy to visualize it because this number here, while x is being represented by time, which is constant, PE is a ratio of two numbers. So let's say we start out with some sort of PE ratio of 20, something generally accepted for a slow-growing tech company. Then the price of the company goes up. People start buying the shares. So what happens? Price goes up. Earnings don't, because this is some sort of fast change in the stock price. So that would mean it would start going up because we have P over E, and when E doesn't change, but P goes up, the entire number goes up. So it starts going up. But then they have amazing earnings, and a quarter comes out, and suddenly this number gets bigger over here, the E. That would mean that the entire ratio goes back down. So this is heightened stock price, and this is heightening profits for a quarter or a financial statement. And it can go either way. For example, if people start selling the stock, then the entire PE will go down. But if the company's earnings go bad and their earnings for the last year are worse, that would actually make the PE go higher. So you're understanding that when you want to buy a stock, a lower PE is usually better, because that would mean either that the stock is being valued lower and you're getting a great value buy, and it could also mean that their earnings are very high. But usually that just means, and then that takes us to our, now that we see how to visualize it, that takes us to our next point. Why? Why do we look at PE ratios? Why are they low? Why are they high? And why do different companies' sections have different acceptable PE ratios? Well, when we look at a company's PE ratio, we're basically looking at how much the market in general trusts it or accepts it to grow. So for example, if we have a new tech company and it's something that's still very, very small, and that would be something that we expect a lot of growth from. So let's say it's a $1 billion company, which is generally pretty small for something in the market. And it just started out, it's making an app, and the app is going nuts, and their earnings are still pretty low. They've just started. So we would expect that the market, so let's say they have $1 million in profit. That's pretty low. But again, they're giving a nice valuation of $1 billion because they're new, they're rising, they're gonna grow. So that would mean we have a very, very high PE ratio, because you're looking at earnings being $1 million and price of the company being 1,000 times bigger than that. So now it makes a PE of 1,000. For reference, Apple, the great tech company worth around $2 trillion as we speak, or AAPL for the ticker name, has a PE ratio of around 30. This is usually what big companies get when they have a lot of growth ahead of them, but they're very based and they're technology companies. This is pretty much the standard. It's what you'll see on things like Google and Amazon, and like we just said, Apple. But let's say we have something less exciting than a new startup that is in the software department. Let's say we're talking about something a little bit more boring. Let's talk about a real estate company. Now, this company doesn't grow rapidly. Let's talk about a very, very based company that has $10 billion of earnings per year, and it doesn't really change much because when you buy new properties, it takes a long time for that profit to come in. So they generally don't grow very fast. So the market doesn't want to give them a valuation of $10 trillion, right? It's not like the last company where we're going to give it 1,000 times its earnings. We'll give it a valuation of $80 billion because this thing pays dividends, and a nice dividend is around 7 or 8% for something like this. So this is fair. This is a fair valuation. And then we get something like a PE ratio of around, well, not around, in this case, perfectly 8. So, now I'm looking at a company, and I'm thinking of buying into that company by buying shares or the stock. I need to look at the PE ratio and think about how well that portrays my image of the company's growth. For example, I want to get into a company because I think they're about to grow rapidly and they're creating insane products that are soon about to go to the moon, and their earnings are gonna grow 3 times what they were last year. And I see they have a low PE ratio of 3. That's a great buy. Well, let's say I'm looking at a company because I think they're very based financially and they're very strong and they're doing a very stable business and have very stable earnings. But I see they have a PE ratio of, let's say, 300, then that means the market might be overvaluing them or valuing them much more than I think I should value them. So that is why we use PE ratios. A PE ratio is our way of explaining how a company is being valued based on the future expectations that investors have for the company. And by the way, there's also something that you may see called a forward PE. And let's think about it. PE ratio is 12 months back earnings, current price. What would forward PE be? Forward PE be the next 12 months of earnings, and of course just the price, so not any different price. So, and this is expected. You never know exactly how much money a company is going to get. These are estimates. So if we expect great growth from a company, usually the forward PE is much lower than the current PE. And that's also another way that you can get, by dividing forward PE by PE, you can see how much analysts think the company is going to grow. Because again, this is next 12 months earnings, and PE is price over TTM, which stands for trailing 12 months earnings. And if we divide this by this, we get how much analysts think the company is going to grow in the next year. But that's not always right, and it's sometimes very wrong. But usually analysts know what they're talking about quite a bit. So that brings us to the end of today's lesson of PE ratios and price and earnings, and what it is, how we get it, and why we have it, and also how to visualize it, why we use it, and everything around. I hope today's lesson brought you a lot of interest and education. Thank you very much for using Happy Trading, and keep trading happily.